In this example, we are going to look at measuring and calculating short-term liquidity. The following information in front of you is given to us for 2013 and 2014. In this example, we will just assess Martin's liquidity and cash flow in relation to the change in payables and turnovers for 2013 only. 2014 would be done the same, only using 2014's numbers. So in 2013, Martin Company had current assets of $310,000 and current liabilities of $200,000, of which accounts payable were $130,000. Cost of goods sold was $850,000. Merchandise inventory increased by $80,000, and accounts payable were $110,000 in the prior year. So the first thing we're going to do is we are going to calculate working capital. Working capital is calculated by taking our total current assets minus our total current liabilities. So for 2013, our current assets were $310,000 minus our current liabilities of $200,000 gives us a working capital of $110,000. This is basically the amount of money that would be left that we have to work with if we took all of our current assets and paid off all of our current liabilities with our current assets. The next, we're going to look at payables turnover. Payables turnover is calculated by taking our cost of goods sold plus or minus the change in our merchandise inventory divided by our average accounts payable. So payables turnover is basically going to tell us how many times do we turn our payables over. How often are our payables paid? How often do we pay what we owe? So our cost of goods sold is $850,000, and it said that for 2013 our inventory increased, so we're going to add the $80,000. And then to find our average accounts payable, we have to take our current year accounts payable, which it says is $130,000, plus the prior year's accounts payable of $110,000, and divide them by 2 to find the average. And when we put all that into the equation, we come up with 7.8 times. So in a fiscal year, we pay our payables about 7.8 times a fiscal year. Then we want to look at our days payable. Days payable is related to our payables turnover. Out of 365 days, about however many days do we actually pay our payables. So we take our 365 days in a year and we divide it by our payables turnover. You will always use 365. We do not account for leap year. So divided by our 7.8 times, we turn our payables over, or we pay what we owe, about every 46.8 days in an accounting period.